Today is Thursday, April 27th. I want to do a video follow-up to my Barron's column this week talking about the low VIX not being a problem. And normally we think of a low VIX, or should I say an extremely low VIX, being somewhat bearish, that complacency reigns, there's no fear, and the market's about to have a setback, if not a real decline. But what I found just by looking through the data, and admittedly it only goes back a couple of decades, what I found was that when volatility really crunches down hard, not just gets low, but crunches hard, it actually is bullish most of the time, with one big exception, and that exception being if it's following a big rise in volatility, it's not so bullish. So we'll take a look as we'll go through these examples. There are about 10 or 15 of them over the last 30 years. And we'll just start with the most recent one. Here is this most recent one a couple days ago. You could see a big jump up in the price of the S&P 500. There is a big decline in the rate of change of the VIX. So this is not the VIX we're looking at on top. And the bottom chart is a rate of change of the VIX, a one-day rate of change. So in other words, a big one-day move to the downside in this case, below 20%. All right. I also looked at moves to the upside of 25%. And how did I get these numbers? They're just eyeballed by looking at the data and seeing where you could get some possible meaning. So nothing magical about them. You know, is it 25%, 26%? That doesn't really matter to me right now. So anyway, we have a breakout. You can see that, you know, it does break out of there, and volatility crunches down. And why does it do that? Well, a bullish event will crunch down volatility because the S&P and the VIX pretty much are opposites of each other. So you have a big change of heart, market takes off, of course the VIX itself is going to come down. I'm going to get rid of this line just because when we move the chart, it's going to look funny. So the last one we saw was election, just before the election actually. Big volatility crunch down. But the signal below 20% down was the day after the election, which is right here. So let me just move that line to the actual crunch day. And you can see what happened. Now you're going to say, okay, unusual time, it was an election, there was something happening there. Well, possibly. Let's keep going back in time. Okay, well, unfortunately this is the one example we have to come back to because it didn't quite fit this script. So I want to come back to this one later. Let's keep going back in time. You can see a big volatility increase on this big sell-off here. So this doesn't give us anything on giving us a bullish signal, but you'll see that when the market really falls apart, you get these spikes in volatility. All right, we're going back in time, and you can see not much happening here. And there we go. This is 2013. It's kind of a similar situation where you have easing back, a breakout, and then this volatility gets destroyed and up it goes for a while. Kind of looks like the election. Moving back in time, here we are at the end of 2012. Again, breakout and away it goes. Okay. Now we're getting into 2011, and here you have a big sell-off, and this is a lot of fear happening here. This is a pretty major correction, and you can see there's your volatility crunch, but the market looked pretty crappy after that, tell you the truth. Sorry for the language. You can see though that it spiked up higher just a few days before. So this gives you a non-signal. All right, then we're going to get through a dry period here, actually one more, and then there's a dry spell. We don't see many signals. Here's another example. You had spike up, spike down, market did not do well. All right, let's just save a little time here. All right, here we are. We're now back in 2008, in the middle, just nearing the end of the bear market. And again, this one kind of broke the mold here, so unfortunately these things are not perfect. I'm doing this video without a script. The one after that, you can see spike up, spike down, so it still didn't do well. So this is kind of an exception here. If you want to tweak the levels, is it minus 20% or is it minus 21%? You could have avoided that. I don't think you would have missed out any of the other examples. Now here's still in 2008, still in the middle of the bear market, and you have a spike down here, but you don't have the spike up beforehand. And yeah, look at that nice run for a while before the whole thing falls apart again. And you use other technical indicators, break down, test, and break again, to know when the party's over. Just more examples. This is wrong. This should be here. And you have the spike up, spike down, so it didn't work. This one, you just had the spike down. Worked for a little while. Anyway, this is not perfect science. This is not statistically sound. I didn't really crunch hard statistical numbers to see if it works and how much and all that kind of thing. But the point is that when you get these crunches down without a spike up just ahead, they tend to work out pretty well. Now there's always exceptions, and let's go back to the one we looked at earlier. Here you have the big spike up, then the spike down. This one did work pretty well. So while you didn't get into this one, you wouldn't have made the trade, you didn't lose anything either. So I guess that's not too bad. So there you have it. I'm sorry, it was kind of a rambling video. I was doing it live without a script, just seeing what's happening and just trying to find these examples of when volatility really crunches down hard, that it's really not so bad. When it goes down, when volatility stays low, that's a different story. I'm talking about just when it crunches down really hard on a one-shot deal. And to me, that tells me, it says that sentiment suddenly surged. And when you get a company a breakout, and you get this sentiment surge, it's a good thing, and it goes up for a while. So there you have it. Again, I apologize for rambling here, but it's information here if you look at it, and I think it's pretty interesting.